And of course, there are lots of things that Wall Street is paying attention to. The Fed meeting, which he mentioned this week. Moody's concerned about AAA countries and small caps outpacing large caps. So let's talk about all of that with our Power Lunch Market Insiders. Joining us now is Phil Orlando, Chief Market Strategist with Federated Investors, and Peter Schiff, President of Euro-Pacific Capital. And he's author of Crash Proof 2.0, How to Profit from the Economic Collapse. Welcome, gentlemen.
Thanks, Sue.
Thank you. I'm going to start with you, Phil, if I could, because we kind of know where Peter's coming from. So I know what he's going to tell us, but I'd like to find out how you feel about things. This is a key week. We do have the Fed making its decision. A lot of people do expect things to be the same. But what about this Moody's comment that the U.S. may lose its top-notch credit rating? I mean, do we care anymore what Moody's thinks, given the subprime crisis and the fact that they missed so much during the economic crisis?
Yeah, I like your comment before the commercial with regard to Moody's, Sue. I mean, they got Freddie and Fannie wrong. They got IAG wrong. I think their opinion at this point is a non-event. We care a lot about what the Fed thinks, but we're not expecting anything out of this week's meeting. No change in language, no change in policy, and it's not going to be till the middle of the year, we think, that there'll be that change in language, and probably the second half of the year before we get a change in rates.
And, Peter, I know that you basically think that the country's on the wrong path, that some of the remedies that have been put in place are not appropriate. But what should the stock market be paying attention to right now and doing?
Well, I think they should pay attention to the fact that we're simply exacerbating the structural imbalances that led to the crisis in the first place. From the perspective of our creditors, I mean, who cares? Yeah, who cares what Moody's says? I mean, they got it wrong in the past and they're wrong now. I mean, if you're thinking about U.S. Treasury debt, think junk bonds, think subprime mortgages. There's no way we can possibly pay this money back. There's only two things that we can do. We can default legitimately, or we can do it through inflation. But one way or the other, the creditors are going to lose a lot of money loaning money to the United States Treasury. And unfortunately, the more money the U.S. government borrows now, the worse our economy becomes, because they're using that money to undermine our economy.
But, Peter, how fast does that show up in stock prices? Because I remember you mopping up the floor with me in a debate we had last April, and you pointed out to these same concerns, and stocks went way up since then.
Well, I didn't say that stocks were going to go down a year ago. We've been long stocks all year. We've been long Chinese stocks. We've been long Norwegian stocks.
What about U.S. stocks?
But U.S. stocks, you told me Dow was going to 4,000 or something like that. I could swear you said that last April.
Well, in terms of gold, it's going to go a lot lower than that. You have to understand value in real terms. We are debasing our money. We're creating a lot of money, and so the result is that prices rise. Stocks are prices, and prices for stocks will go up in nominal terms if we print enough money, and we certainly are doing that right now.
If I buy your view, Peter, excuse me for interrupting, I beg your pardon. If I buy your view, Peter, what do I want to own? Stuff?
Well, sure, but you want not just any stuff. You really want to look at where standards of living are going to rise, where you don't have these huge structural problems. That's why I'm focusing on Asian economies. That's why I'm focusing on natural resources. That's why I'm buying a lot of precious metals.
Okay, but Phil, isn't Asia potentially overheated? I mean, if you look at the China and Shanghai stock market versus the New York Stock Exchange, which one's more likely to have a big jarring correction if you're afraid of that risk?
Well, the reality is that our models are suggesting that emerging markets are still pretty attractive, certainly compared to developed markets. So we've still got a pretty sizable exposure there. And I agree with Peter that commodities at this point, metals, energy, even agricultural commodities, still look relatively attractive here as well.
Do you not buy U.S. stocks here, Phil?
We still like U.S. stocks.
Why?
I mean, yes, we're up 73% in the last year. So we don't expect that we're going to see anywhere near that kind of a return going forward. But again, we believe that the recession ended mid last year. We're seeing a very solid economic recovery that we think has legs, and it will continue over the next year or two. And we think that economic growth, corporate earnings, and corporate revenues are going to continue to chug higher.
Yeah, all we're seeing, though, is the Fed trying to blow air back in the bubble. They're going to get a little air back in there, but it's not going to stay there. It's all going to deflate again. The worst part of the recession is still in front of us. In fact, I still think that by the time it's over, we're going to be calling it a depression. We'll be calling it an inflationary depression.
All right. Mattresses for everybody.
Yeah.
Okay.
Mattresses all around.
Peter.